welcome to Indianomics. It is the last weekend before the credit policy. Traditionally, this is the most important policy, being the first one in the new financial year. The markets and the economy will not only watch for the rate action, but also for RBI's assessment of the new year, its growth and inflation forecasts, as also the governor's views on the prevailing external environment, which by any reckoning is quite important. We will discuss all these threadbare with three top-notch economists. But before that, my colleagues Ritu Singh and Manasvi Gilani have polled a cross-section of bankers, bond dealers and economists on what they expect from the policy. Here's what they found.
Governor Rajan has surprised the market twice with out-of-turn rate cuts on January 14th and March 4th. In the intervening scheduled credit policy on February 3rd, he refused to cut on grounds that the rate cut had just 20 days before on 14th January. Consequently, this time around too, 75% of the bankers and economists polled by CNBC TV 18 said they don't expect a rate cut. After all, Governor Rajan gave one just a month ago on March 4th. Also, the only inflation data that came after March 4th surprised on the upside. But does that mean he will cut the CRR? An even more overwhelming 85% said no. Though a small minority is expecting RBI will cut CRR by 25 to 50 basis points, CRR being the percentage of their deposits that banks must keep as cash with RBI. Will RBI cut the SLR, percentage of those deposits that banks must invest in government bonds? A good 40% said yes, though even here a majority of 60% said no cut. This being the first policy of the year, the market is also watching for RBI's growth forecasts. This is a tricky issue for RBI after the CSO, while revising the base year from 2004 to 2011, revised the FY15 growth forecast to 7.5% from much lower levels earlier. A majority or 60% of our respondents expect RBI to forecast a 7.6 to 8% GDP forecast this year, that is FY16. The governor's speak on inflation will be closely watched. Is he lowering his inflation target from FY16 from the current 6%? When we asked respondents if RBI will meet its FY18 target of 4%, the replies were mixed. Only a minority of 40% gave a high probability of 75 to 100% of meeting this target. 60% was very low chances of RBI meeting this target. Accordingly, the number of cuts expected hereafter also varied. A majority of 65% said only one more cut is possible. 30% said 2 more cuts are possible. Only 5% said 3 more cuts are possible. 65% of industry experts expect the next rate cut in June. 15% see another mid-policy cut in May, and another 15% see the next cut in August. Besides rates and forecasts, the governor could make regulatory announcements in the policy such as schemes on monetization of gold or standardizing the ways banks calculate the base rate. Above all, governor's comments on the rupee will be closely watched out and parsed. In Mumbai, with Ritu Singh, Manasvi Gilani.
All right, thanks Ritu, Manasvi, for that. And now, to get some opinion on these findings, I have with me my star panel of economists. Let me introduce them. Bhanu Baweja, Head of Emerging Market Strategy at UBS, who has specially flown down from London, joining me in our studio. SONAL VARMA, the Chief Economist from NOMURA, and SAJJID CHINOY, the Chief Economist from JP Morgan. Gentlemen and lady, welcome. Well, let me start with you, Bhanu, since you are in a sense cut away from the noise in India and in Mumbai. From your perch over there, what is the general expectation that there will be rate cut, there will be many rate cuts?
I think the markets are expecting a series of rate cuts, actually. If you look at what's priced into the curve also, I think the markets are expecting 2 rate cuts, and perhaps they're hoping for more. My sense is that they're taking the view, and this is not just specific to India, I think this is also across emerging markets. They're taking the view that emerging markets can conduct monetary policy independent of the Fed. I think that's slightly over-optimistic. I think that's slightly rich. I'd expect that we get cuts in India, and if we were to get cuts, we'd get cuts sooner rather than later. So I think April 7th we can get a cut, and it's possible that we get one more cut after that, right? We ourselves do think Indian debt represents pretty decent value, but that's not because the central bank is cutting. In fact, on the contrary, it is because the central bank is saying that we are focused on providing a positive real rate of return to investors, right? And that's more than many central bank governors elsewhere in EM are doing. So I think that's quite important. As holders of longer term debt, I think we're in good hands with Governor Rajan.
All right. Well, I'll come to you again for the growth forecast, which will be very important, especially because they're confusing. But Sajid, to come to you, what's your sense? 2 cuts is what at least global investors seem to be expecting if Bhanu represents the London view.
I think the space for monetary easing is a little bit less. We have 1 cut in, and I think for a couple of reasons. One is that, as Bhanu mentioned, I think the focus is very much to keep real policy rates positive. The governor has actually given us a range of 1.5% to 2%. We have to look at that across the cycle. So it's unlikely to be the case that inflation remains at 5% over the course of the economic cycle. Our own forecast is somewhere between 5.5% to 6%. So if that is where inflation averages over the next 12 to 18 months, and you add on 1.5% to 2% in terms of a real rate, you're looking at the policy rate somewhere between 7 and 7.50. So I think 7.25 is where we are. But I think there's another element to this which we cannot ignore, which is that a lot of the monetary easing this year was contingent on there being fiscal consolidation, which opened up more monetary space. And we found that there's much less of that. In fact, we find that the fiscal impulse this year, center and state combined, could well be positive for the first time in 7 years. I think that won't be lost on the RBI. And I think that's
what is the number you have in mind?
Takes away. We know the central government deficit, net of asset sales, is programmed to expand by 0.1% of GDP. Having analyzed the state deficits across the board over the last month, the sense is that there's almost no fiscal consolidation happening there. So the combined deficit, net of asset sales, picks up by about 0.1% this year. And then if you cyclically adjust it, given that output gaps may close this year and growth picks up, you're looking at a fiscal impulse of about a positive impulse of about 0.3%, which means fiscal policy is expansionary after 6 or 7 years. It may not be a bad thing given where growth is, but it does correspondingly reduce the space that the central bank has. So we're going with 1 more cut, but not in April. I think the cut will be in June. There's a sense here that India is far more insulated from global shocks, and therefore even if you act in June, which is closer to any Fed liftoff, that would be okay.
Okay. Well, Sonal, I read your report and you make a very strong pitch that rural wage growth, which was slowing down perceptibly, has picked up rather sharply. Does that reduce the space for rate cuts?
Yes, Latha. I mean, it's not picked up sharply. I think what we are seeing on the rural wage front is really wages starting to stabilize now. So in the last 12 to 18 months, we've seen rural wages, sort of collapse from growing above 20% to now. It hit a low of about 2 to 4% in November, and in the last couple of months, it's actually come back higher to around 6 to 7% in that range. Our sense is that what we're seeing is rural wages stabilizing, and I think this is important because when we talk about CPI inflation, we know that more than 80% of the CPI basket is largely non-tradable, and it's really wages which drive the cost for non-tradable that drives the future direction for inflation in the economy. So I think what the wage numbers are suggesting is that we are the big disinflation we had seen in India in the last 12 months is largely behind us. There can be some undershoot in the short term, but on a steady state basis, we are more likely to see inflation stabilize rather than continue to actually moderate. I think the bigger debate we need to have, therefore, in that context is, how much of the inflation fall is cyclical versus more secular decline in inflation. Because oil prices have collapsed, rural wages have collapsed because of the cyclical slowdown in the economy and because of the reversal of some of the government policies, and the shocks from vegetable prices have been fairly subdued in the last 6 months, which could reverse going forward given the unseasonal rains we have seen. So our sense is that the steady state basis CPI is still around 5.5% in the economy, and therefore policy has to be cognizant of that.
Okay, so in your book, is that one more cut, no more cuts?
Right. I mean, our base case is for no more cut. I think the language used in the March surprise intermeeting statement was that RBI has preempted the rate cut given weakness in the economy. So our sense is that RBI has front-loaded the interest rate cuts in order to give more time to banks to respond going forward. So I guess the focus in this policy should be much more on transmission rather than RBI actions per se. So unchanged at the April policy is our expectation.
And not many cuts even thereafter. No cuts thereafter.
Yeah, I mean, we are saying that there's probability of one more cut, maybe about a 35% probability. But if the growth cycle is expected to pick up, and most of the indicators that we track suggest that we are in the initial stages of a business cycle recovery. Second, inflation is stabilizing around 5.5% right now.
Okay.
Plus, given the RBI's medium-term inflation target of 4%. Third, completely concur with SAJJID that on a general government basis, the fiscal stance actually is expansionary. It's not contractionary. And fourth, if the RBI wants macro stability, which means that you don't want to depend too much on foreign flows to fund your current account deficit, you need to continue to provide a higher real rates to encourage domestic savings. So in that context, our expectation is that policy rates are already close to neutral. So really not much space for the aggressive easing that some parts of the markets are pricing.
All right. So I think it's a neat representation of your extremely well-argued cases. Bhanu saying 2 cuts, Sajjid saying 1 cut, and Sonal saying even that 1 cut is only a 35% probability. We have to take a break on that note, but lots more questions on growth, on the external environment, all that in a minute from my experts.